Hi, this is Tony D'Amico, founder and managing partner of Fidato Wealth. Thanks for joining me today for this webinar style video, as I wanted to discuss the Fed raising interest rates on Wednesday, September 21st, and some of their statements, which I think are very important to discuss. So let's jump right in and I'll share my screen with you. All right, so I'm recording this video on September 27th, 2022. So the title of the video on our YouTube channel is called Navigating the Rough Road Ahead. All right, so we want to talk about today the power and impact of rising interest rates. So interest rates have been have gone up by 3% by the Fed for the year so far. We want to talk also about pitfalls to avoid during these challenging times, and how we're managing both risks and opportunities at hand during these times. So the power of rising interest rates. So interest rates rising definitely has an impact on the economy and definitely makes a large impact, to say the least. It affects the value of money. It affects the cost of borrowing money. Rising interest rate has a negative impact on businesses, their profitability, and their earnings. Rising interest rates also affects the trajectory of employment, of jobs, the overall economy, and the stock market. So yeah, rising interest rates obviously has a big impact, right? So businesses that need to borrow money, perhaps it's to hire employees or to do research and development or invest in facilities, right? The higher those costs of money, it reduces, I guess, demand, businesses, seeking out those loans and making those investments. No different than how mortgage loans have increased. And we'll actually talk about that here coming up. So the Fed acknowledged, so I think the big shift that we saw last week was, they're maintaining that same path, but the language is becoming, I believe, a little bit more powerful and clear. So the Fed acknowledged that reducing inflation will likely require both a quote, a sustained period of below trend growth and a softening of labor market conditions. Why is that? The Fed's goal is to decrease the demand for goods and services to bring it more in line with supply, and in result, lower inflation to 2% annually. So they know that the best way to decrease the demand for goods and services is to have a period of, again, sustained below trend growth and softening labor market conditions. What we also see is that housing pricing is starting to decline. It's important to note that housing price changes, unlike how the stock market quickly reacts to Fed policy, adjust gradually like a steering ship. So home sales are what we refer to as a lagging indicator. So a lagging indicator is a measurable data point that changes after the economic factor with which it's related to changes. So mortgage rates are pushing down the affordability of homes, and it's starting to affect demand. So we're also starting to see rent starting to decline in certain areas. So you can see here the shift in home values between May of 2022 and August of 2022, according to the Zillow Home Value Index. So you can see here, there are some parts of the country that are experiencing a 10% decline in home values. Again, the decline in home prices is going to be much more gradual, like steering a large ship. Now, conversely, the stock market is a forward-looking indicator. So their valuations, the valuations in the stock market reflect expected future earnings. So again, a leading indicator, by contrast, is a measurable data point that may help to forecast future economic activity. So the stock market, again, it reflects expected future earnings. So history has shown that the stock market will often react quickly to rising interest rates, but conversely turn upward while the economy is still in recession. So markets will often, again, stocks will often go up because expected future earnings are expected to be higher. So the economy could be in a recession, and at some point, stocks go up because of that expected future earnings improvement. No one knows for sure, but we may be most of the way to the bottom. Again, no one knows for sure, but the stock market, because it reacted so strongly to the Fed announcement, right? It's reacting to the Fed's dedication, persistence to bring back inflation to 2% annually. Why is that? Price stability is really important for an economy. Hyperinflation can have a significant negative impact on the economy, and the Fed cannot be any more clear that they will see this through and that they feel like they have the tools to do so. Again, rising interest rates is not a small change. It is a powerful impact that will affect the economy, the labor market, company profitability, many different areas as a whole. So again, when markets do turn turn upwards, sometimes it's a sharp upturn. And again, if you're not in the market, you lose out significantly. Then that's what makes investing challenging, right? Obviously, it would be easy if the markets just went up. But the part that makes it challenging here is that the markets, again, are forward-looking. We could be in a recession. At some point, we'll be in a recession, and the market will turn upwards because, again, of expected future earnings improving. All right, so we talked about if you are not in the market when there is that upturn. So we do know by looking at history that some of the best days in the market often occur right after the worst ones or close to the worst ones. Now, is history a guarantee of the future? Absolutely not. But we do want to also rely upon the evidence in the market and use that as a guide for decisions that we feel are going to be give the highest probability of achieving success in investing. So Dalbar does this study every year, and they've been doing this study for quite some time. And they measured the results over 30 years, right, of what did the market return versus the average investor. So you can see the S&P 500, if you invested $100,000 over the past 30 years, it would be worth a little over $2 million. Conversely, when they study investors and when they buy and when they sell, their result during that same period of time was $790,000. So they achieved less than half of what the market itself returned, right? So you probably have heard the saying that investments are better than investors. Again, investing is challenging. What this reflects is that most investors will make the wrong decision and let emotions creep in. And again, the average investor often sells low and then buys high. So obviously doing the opposite is key to achieving long-term success. And I obviously share that with you because I don't want you to make that same mistake. So rising interest rates, there's also a bright side to that. So one thing that's occurring is that the bond funds that our clients own, they're receiving more interest. And that interest is then automatically reinvested into the bond fund. So interest rates are going up, so bonds are getting more interest. So that's really important to note. Stock valuations have declined. There are investors out there that are buying the dip, and I really think that investors are looking at this dip differently. It's not like the COVID dip where they're anticipating a quick, sharp rebound. I think investors are buying the dip, knowing it could drop further, but they're going to dollar cost on the way down. So this applies to somebody who perhaps had a large lump sum of money come into play, had too much cash on the sidelines, but it, again, it isn't affecting people that are fully invested adequately with their situation. Interest rates. So the amount of interest that you get, it's a factor. There's two factors that determine it: the credit quality of the bond that you're investing in. Obviously, the higher credit quality, typically the lower interest you get. The lower credit quality, the more risk, therefore the more interest. And then the length of the term of the bond or treasury that you're buying. So typically the longer the term, the longer you have to hold it, the more risk, so the more interest that you would get. And I'll review that actually on the next slide, and we'll also discuss that next bullet point then as well. So here's what we see what's happening with treasury yields now. So you can see the 1-year US Treasury is paying about 4%. A 2-year Treasury is paying a little bit more than that. So there has been a flight to short-term, high credit quality, which typically happens when there's an economic change like this, where economic outlook is not as favorable. It's changing. And this is what happens. There's a flight to short-term credit quality. So our clients are benefiting from this twofold. One is that they have a fund that invests in short-term debt instruments. The fund maintains a value of $1. The only thing that fluctuates is the amount of interest, and it invests in things that typically have a 1-year duration or shorter. And our clients also have a short-term bond fund that invests in investment grade, so high credit quality, short duration, both corporate and government bonds. So, and then the other bond funds, again, this is a short-term thing. So eventually things will level out and the longer maturity items will pay more interest. But right now there is that flight to quality. So the other thing to talk about again is the importance of having a portfolio that's balanced with both stocks and bonds. So this shows you over a 10-year period, if somebody just invested in stocks during that decade here, between 2000 and 2010, the portfolio would be at a loss. Again, bonds, 97% of the time, they move in an uncorrelated manner with stocks, right? And that's what we want. We want, ideally, when stocks are not doing well, bonds to be doing better. And that's, you can kind of see here from 2000 to 2010, a balanced portfolio of stocks and bonds averaged just over 6% annualized. So it's just a reminder that our clients, based upon their level of risk, will have both stocks and bonds, in their portfolio. So let's talk about how we're managing risks and opportunities. A couple of things. So one is, I mentioned the fund that invests in short-term debt instruments. So that fund, again, maintains the value of $1. That makes up 5% of the bond portfolio, regardless of what risk level you're in. So that remains constant across risk levels. We did that because clients are typically not spending more than 5% of their total funds in any given year if they're retired taking distributions. So that is one of the 14 positions in the portfolio. And it, again, maintains the value of $1. So for us, that is kind of an emergency fallback position. We also have short-term bond funds, a short-term bond fund in the portfolio. Again, that's a very conservative position. That value does fluctuate, unlike the cash equivalent fund that's in the portfolio, but nonetheless, it does add a layer of a position that has much lower risk in the bond category. And so these are great fallback positions. If a distribution is needed, making sure that that portfolio has those 14 options to pick from. And that kind of goes into retirement income management. So we're very strategic for our clients that are retired and taking distributions. We're very strategic on what funds we're selling to fund their distributions. And when we fund a distributions for a client, what we're looking to do is set aside a year's worth in cash, so that way they have a year to deplete those funds, which then gives us that next year to be strategic about when we rebalance, when we liquidate, and again, what we liquidate. So we have those 14 different asset classes in the portfolio that are not perfectly correlated. So while some are doing well, others aren't. And obviously we're going to sell the positions that have done the best in the portfolio and let the others that have done the least well, continue to stay invested without interruption. So dollar cost averaging both in and out of your portfolio. Again, that's what we're referring to there as we manage, again, how we help our clients dollar cost average out of their portfolio, right? When they're retired. Conversely, we have a lot of clients that are not retired yet and they're dollar cost averaging into their portfolio. So again, stock valuations are down tremendously. I think this is a great opportunity if you have excess cash on hand to invest, right? It may not be the bottom. I wish I had that crystal ball to tell you when the bottom would occur. But buying in on the way down, I think, is really important. And then also rebalancing. So again, what we're doing, what is rebalancing? Rebalancing is a systematic way of selling high and buying low within your target portfolio. And it helps you stay disciplined. So when a client invests into their portfolio, we rebalance. So if they have an existing account and they, invest 100,000, it's going to be rebalanced into the portfolio according to the target allocations. It will, buy the losers first and then buy the winners later. Conversely, when we rebalance out of the portfolio, it's again doing the same thing for income purposes. It's going to sell the winners first, sell the losers last. So again, these are both examples of staying disciplined, both when markets are lower. Staying disciplined, investing if you have excess cash is important. When the markets are higher, it's also not chasing more risk because we think every day is going to be sunny from that point forward. Diversification refers to spreading out your money across different investments. That's critical. Asset allocation refers to spreading out your money across different asset classes. Again, we have portfolios that are very intentional, very well thought out, and also managed on an ongoing basis. So that institutional management. So we have institutional managers who are monitoring the holdings, whether they're stocks and bonds, on a daily basis. So these are people with offices globally, teams and campuses of people that are monitoring the holdings. I think it's also really important to rely and lean on your comprehensive financial plan and its probability of success. So whenever we work with a new client and even existing clients, we revisit the plan annually. It's very important to do. Ensure the probability of success is adequate and in line with the client's goals and needs and our overall comfort level of having a healthy plan. That probability of success does factor in some bad market conditions or market shocks. So that's important. And then also falling back on opportunistic planning. So I'll talk a little bit more about that here on the next screen. So, I think it's important to note that controlling what you can control is important, but sticking to your plan does not equal doing nothing in our eyes. So again, we have a playbook that we fall back on. When markets are declining, what can we do to take advantage of that for our clients? We conversely have another playbook. When markets are doing really well, what can we do to take advantage of that for our clients? So when markets are down, debt restructuring is always important to do. Tax planning is huge at this point in time, especially with Roth conversions. So if you're doing Roth conversions, if we're helping you with that, and you're doing conversions of more than 50,000 per year, I would encourage you to email us to start a dialogue. Now, we've already started Roth conversion process internally. We're reaching out to all of our clients that are doing Roth conversions, coordinating with their CPAs to get that done. So this is an advantageous time because you are converting shares. Typically, you're not selling investments. So you can convert more shares right, at this point in time. So when the markets do improve, that'll help out the Roth IRA, which obviously grows tax-free, and you can take income from it tax-free. Investing, if you have extra cash on hand, I think that's also really important. Again, markets are down, and we want to help you take advantage of buying low and selling high. If you typically make contributions to your IRA, Roth IRA, or other investment account, again, now might be time to make those contributions if you haven't done so already. We also help our clients manage assets that might have a tax loss. So we'll look at harvesting losses in certain positions to reduce tax liability. Another important point is if you're planning to retire in the near future, I think it's really important to revisit your plan and make sure you're comfortable. Two other items: if you're planning a major purchase, if those funds are in cash already, that's great. If not, you may want to reconsider the timing of that major purchase. So we have interesting times, right? The markets are down, interest rates are up, right? So there's a different conversation we're having now when we're looking at, should a client take out a home loan or not? Do you have other planning areas that we've identified mutually that are in your best interest that still need your attention? So I think that's important to always be pushing the ball down the field, if you will, and taking steps to further strengthen your financial position. All right, so one last thing to review with you guys before we wrap up. I think it's really important to avoid anything associated with this phrase that this time it will be different. Again, so far, and every time I've heard somebody claim that, they've been wrong. And again, can the evidence in the stock market going back to 1926, can that evidence and that data that is statistically significant, is that a guarantee of the future? It is not. But I don't know of any other way to achieve the goals that people have with their investments and their plan, unless they do what is considered that's going to give them the highest probability of success. And that's what we focus on. So if we look at the long term, right, and look at the returns of stocks from 1926 to 2019, and we look at these different time periods, right? So over a 10-year period, there's only a 5% chance that you will lose money or have negative returns. A 15-year is only 0.2%, right? But our brains are not wired to think this way, right? Which is why we always are talking about the long term. One of my favorite Charlie Munger quotes. So Charlie Munger, if you don't know, is Warren Buffett's business partner. Charlie Munger states that wealthy people stay invested through all market conditions. And I think that's really important. That's one of my favorite quotes. I think that holds true and is the best path forward, is to stay invested and look for opportunities. He also said that, looking for opportunities. The other quote that comes to mind from Charlie Munger is, he said, he said that wealthy people invest in stocks, bonds, real estate, and have the adequate cash on hand that they need. And that's exactly with what we do for our clients, right? Now we invest in many different types of stocks, large cap, mid cap, small cap, value, international, emerging markets, etc. We invest in a real estate fund. We invest in various types of bonds. So, and I think that's very true. We didn't fall victim to the Bitcoin craze, right? Bitcoin has crashed, and we don't invest in things that there isn't the evidence for, right? We follow that evidence-based investing path. I believe it gives the highest probability of success. It's considered best practice amongst fiduciary advisors. And we're going, if there's one thing that I learned as we kind of go on to the conclusion slide. So I guess my biggest takeaway, if I look back and think about going through 08 and 09, professionally and personally, It was obviously challenging, right? But going through that was a great experience, right? Sticking with the investment plan is really important. And the same thing, there's been other dips besides that, but the other one that sticks out was the COVID dip, right? That was a sharp decline for about 33 days. And, I had a client ask, Tony, how do you handle that? And I said, it's pretty simple. We just execute on the investment strategy that we have. And we rebalanced when the COVID dip happened. We rebalanced last week for our clients. So we'll continue to rebalance and take advantage of dips. But wealth accumulation, it's like planting a tree, right? So you have to be patient. All right. So in conclusion, I do believe that this rebound is not going to occur quickly. I don't have a crystal ball, but this seems like it'll be a longer, rough road ahead of us. I don't think it'll be anything quick. I wouldn't be surprised if it's not until sometime in 2023 that we see maybe the stock market, or the overall economy improve. But again, the stock market's a forward looking device, right? So it could go up even when we're in recession, which obviously makes the case to obviously stay invested. I think it's really important to keep the long term in mind. Again, to fall back on the evidence. Also, I think it's really important to turn off the news a bit. There's not a whole lot of good news that's going on economically, socially, politically, whatever your current concerns are, social, political, or economic. There's not a lot of great news out there. I made a decision to get my news by reading kind of digital newspapers. So I read the Wall Street Journal every morning. Probably not a big surprise, but I do not watch the TV news, right? And I also do follow several economists that have a long-term track record that I think do really good work. So that's where I kind of get my news from for the most part. So I think turning the news off for a bit. And then lastly, is just taking opportunistic actions that are in your best interest. So that is one common thing that I see with people that have a plan and continue to strengthen their plan, is they're focused on the opportunities at hand. Again, sometimes those opportunities mean staying disciplined. Sometimes those opportunities mean doing something. So my sincere hope is that you found this video of value, that the information we talked about today helps you avoid some costly mistakes, but more importantly, helps you take advantage of the conditions that we're in. And if you have a solid financial plan and you're comfortable with the probability of success, our goal for our clients is that you are out there enjoying your life, right? You worked hard for it. Chances are you've done a great job saving. So again, if you do have a plan that has an adequate probability of success and you've addressed the array of investment planning, estate planning, risk protection planning, tax planning, all of those different areas, our hope is that you rely upon that plan, fall upon that plan, and work on just making the most, making each day a great day. So if you have any questions, feel free to email us. We're here for you. As your trusted fiduciary advisors, we're going to continue to we're going to continue to monitor the markets. We're going to continue to look at the economy and keep you abreast of any continued economic changes. Thanks so much for joining me today, and have a great day. Take care.